Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Treasury yields hit multi-month highs with traders on edge ahead of this week's Fed decision. Nvidia gets a boost after President Trump says the world's most valuable company can sell its H200 AI chips in China. Plus, Bloomberg has learned that Germany is set to make a record €52 billion defence order as part of its push to build the strongest military on the continent.
OK, here we go. Day one of the Feds. Markets start to hold their breath. Equity markets are certainly holding their breath on either side of the Atlantic. Take a look at the futures picture stateside and here in Europe. We are waiting for that Fed decision coming tomorrow. Euro Stoxx 50 futures. We are effectively flat as a pancake. The Australians a little hawkish. We are going to wait and watch and see what happens. We are maybe potentially looking at a rate hike somewhere down the road from the RBA. Plenty, though, still believe that another cut could come. The US 10-year stubbornly, look at this, stubbornly north of the 4 mark. We're at 4.17. What happens with the Fed decision? That is going to be the key thing that we are now watching for. And the countdown to the opening trade on that note starts right now. Tuesday the 9th, good morning. We are focused firmly on what happens with the Fed. So many questions. Actually, is this meeting going to be useful? Are we going to learn anything useful from the SEP? The dot plots, are they going to tell us anything? What kind of a decision are we going to get? Is it going to be hawkish? Is it going to be dovish? Which presents the biggest risk for the market? You do wonder whether actually a dovish decision today could upend a lot of trades. So there's a lot to play here for, but the Fed doesn't know very much. So I'm wondering what Powell is going to say today.
Yes, I'm wondering what he's going to say this week. I'm wondering whether the guidance is going to be as hawkish as the market maybe feared, expects it to be, to your point. Maybe that is what the market expects right now. Treasury yields then at the highest in 2 months. And there's a global flavour to what's going on here as well. You've mentioned the Australians this morning. Guy, we spent a lot of time yesterday talking about the ECB and the slightly more hawkish lean there. That sent bond yields up globally. Some of that's built into the US session, but of course there's the Fed dynamic as well. But the long end of the Fed, and you pointed this out talking about the 10-year, there is resistance at that 4.17 is where we are at the moment on the 10-year yield. Yep. And there's been a lot of conversation about how these yields are resistant to Fed cuts at that kind of long duration. And now we've got Man Group talking about whether we're going to need more QE. We've had conversations about yield curve control. Sure. All of these in the mix.
So Powell gets everybody around the table today. OK, sits down. What does he say to them? Like, what do we know? Like, how are we going to make decisions here? What happens next with this economy? The absence of data is a big problem for the Fed at this point in time. So as he sits down and addresses those around the table, tries to build a consensus, and we could see quite a lot of turbulence, what does he say to them?
Yes, and how do we cast the characters in this particular dialogue right now? Because normally John Authers, I mean, I don't know if I like this or not, it seems pretty mean, but John Authers is talking about how we don't have just hawks and doves, we also have lame ducks to talk about at the Fed. And this taps into that serious point we've been making for a long time about who is the market going to listen to as soon as we understand who is going to lead the Fed over the next years.
There's a nice line at the end of that piece, though, that talks about the idea that maybe actually Powell is allowing, encouraging, desiring dissent because it points to the idea that the Fed is independent and sets up the fact that if Hassett comes in, he shouldn't expect an easy ride from this committee. Yeah,
I mean, dissent in central banking is a common theme around the world.
Not the Fed, though.
Exactly, but that's the outlier, it would seem, at least on some measures. Anyway, yields have been rising on this. Is that because everyone's worried about inflation? It is a bit of a global theme, as we've been saying, with the BOJ, the ECB, and the Australians now as well. Or does it tell us something about the US economy and some resilience? But anyway, we will talk about that, continue to address that.
One of the reasons why the US economy has resilience is AI.
Yes, absolutely it is.
Takes us on to the Nvidia story and kind of what is happening there. They can sell them. Will the Chinese buy them? The H200s. Now, the US product that is available is obviously becoming much more advanced. We're moving on to Rubin. The difference in performance between the chips that are on offer to China and those available in the United States is still significant. But the fact that Jensen Huang has been able to persuade the Trump administration to allow him to be able to sell these chips into China, I think is a big win. And actually, in some ways, is even more significant than the actual technology that's going to be delivered. The political message that's going to come back the other way, I think, is going to be fascinating. How do the Chinese feel about this? They want them? Do they not want them? There's been indications recently that they don't. is that something that will hold their industry back, or will it encourage it to advance more quickly?
Yes, absolutely. So these are not as good, as you say, as the Rubens, the Blackwells, the top-end US chips that Nvidia makes itself. But these are better than what seems to be at least openly, obviously, on offer from the likes of Huawei and others within the Chinese space. So that's why it becomes important. And the political response to that is also important. I mean, President Trump says that he's had positive signs from Xi on this, but there had been pressure applied to Chinese businesses to not take these kinds of chips, especially as they weren't the top end. But we saw Nvidia move a little higher on this. AMD also moving a little bit higher on this yesterday, as this is something that, if they pay their money to the Treasury in the United States, they are then going to be able to sell these advanced chips.
That's the amazing bit about a 25% surcharge.
Yeah.
America gets its little cut. A deal has been done. Absolutely fascinating. Let's turn our attention to what's happening in Germany. German 10-year has been extraordinary over the last few weeks. We've seen a significant shift higher in terms of the yield profile there. What does that signal? Is that signaling that actually the spending plan is on track and is going to be delivered, and that's going to have an impact for the Bund market? And today we learned, Bloomberg has learned, that we're going to see some big spending decisions next week. We are going to see a, 52 billion announcement when it comes to defence procurement. We've been waiting, obviously, for some of these big packages to come through. We're going to get a big lump of them next week.
Yeah.
And does it just put us back on track? Does it kind of just reinforce the idea that Germany is going to deliver this spending push that is so critical to what Europe needs right now?
And so some of this might be in the price in terms of the Bund markets. We are watching DAX futures tick higher, though, and that is partly because defence names are expected to go higher. Not all of them. We've had some earnings that came with some guidance that may be disappointed for some, ThyssenKrupp in particular. But we are expecting the defence names to go higher at the start of trade. And in terms of the size and scope here, 29 contracts, 52 billion euros. Maybe this is in the price for Bund markets, because Bund futures are not doing a huge amount, but we will look at how they open at 7:30. But the size and scope I found really fascinating. It will mark, this is the event next week, it will mark both the largest number of big-ticket orders and the highest value of government contracts approved by the Budget Committee in the Bundestag, lower house of Parliament, in a single closed-door session. So this is big spending from Germany.
Absolutely. And that, you think about the sort of the history of what Germany has done over the last few years and its wind down of its troops. This is a rapid catch-up that Germany is trying to deliver. We're going to talk about all of this with our guests that are going to be running with us throughout the show. We've got some great guests coming up. Maria Louise Albuquerque, European Financial Services Commissioner, is going to be joining us, as will Chris Watling, Longview Economics CEO. What is happening in terms of the narrative around these Fed cuts? What is going to be going on a little bit later on? How does Powell convince the committee? Madison Fowler, JP Morgan Private Bank Global Strategist, joining us around 8 o'clock. And from Abu Dhabi Finance Week, we have Lawrence Golub, GC Advisors CEO, joining us from the Abu Dhabi Finance Week. What else do you need to know this, Tuesday morning? Tuesday already. A US judge has ruled that President Trump's executive order banning new wind projects is illegal. The ruling says the president's January order was, quote, arbitrary and capricious and contrary to law, sided with more than a dozen US states and clean energy groups. The order froze dozens of projects, including large-scale installations planned off the eastern seaboard of the United States. And watch some of the European wind names as we open the markets in 51 minutes' time. The US Supreme Court has signalled its willingness to give the president more control over traditionally independent federal agencies. During a hearing on Monday, justices suggested they will let the Trump presidency permanently remove Rebecca Kelly Slaughter from the Federal Trade Commission. That despite a law saying commissioners can be fired only for specified reasons. The ruling could undercut the independence of the Federal Reserve, but conservative Justice Brett Kavanaugh has indicated quite strongly yesterday, actually, that he would reinforce a carve-out that the court has created for the central bank, and did so back in May. And to the media landscape, Paramount has launched a hostile $30 a share cash offer bid for Warner Brothers Discovery, days after the company agreed to a deal with Netflix. Paramount's offer is for all of Warner Brothers, while Netflix's offer is for the Hollywood studios, HBO and streaming businesses. Both bidders are likely to face an extended review by global regulators, something that President Trump referred to when asked about the deal.
I have to see what percentage of market they have. We have to see the Netflix percentage of market, Paramount, the percentage of market.
Deal making, and Trump wants in, and Trump is part of this, and Trump's son-in-law is part of this, and the whole story is incredibly convoluted. I just wonder at the edge whether Netflix shareholders might actually be quite happy about this. You do wonder whether or not they're a little concerned about maybe the prices that are being paid and the possibility of a bidding war. But the Trump involvement is extraordinary.
It's an incredible story. I mean, someone might make a movie about it. I mean, who would make a movie about it? Maybe some of the businesses involved. One thing I thought was really fascinating was the move in session yesterday in Paramount shares.
Yep.
Now, it's not always the case that bidders' shares go down when they make offers, but the market has to have a lot of confidence that you're going to be able to deliver something really special for the shares in the bidder to go up on the day that they offer. And that's what we saw. And not just up, but up by 9%. And the deals team pointing out that maybe this is something really significant in streaming to bring together two of these possibly big names in streaming to be more effective competition for Netflix.
Absolutely. Or you could argue that this is the Trump effect, that once the president gets involved, and you've seen this time and time again with stocks that the president focuses his spotlight on, you see these stocks going higher. He clearly is personally involved now, it seems, or his family is personally involved in this process. Does it come with a halo effect?
Yeah.
Is that 9% a representation of that halo effect?
But even then, and it's a good point, but even then, if you thought that meant that this deal was more likely to go through, I could certainly imagine other bidding situations when that might mean that the stock did not rise 9% because it was more likely that they were going to have to spend the money. But anyway, really fascinating story, and I hope someone makes a film about it one day. It is 7:10 here in London. A lot to talk about this morning. Coming up on the programme, the German industrial giant ThyssenKrupp says it expects to swing to a loss in the current financial year. We'll check on the stock at the open. Plus, French Prime Minister Sébastien Lecornu faces a key vote on the social security budget today. Up next, we'll speak to the European Financial Services Commissioner Maria Luis Albuquerque on how she plans to revive confidence in the sector on the continent. If you have any questions, get involved in these conversations. IB plus BBTV Go. That's the function on the Bloomberg terminal. This is Bloomberg.
Europe has a problem. I think they accomplished an unbelievable thing, but it got bogged down. It takes 27 nations, to make a decision. They have some wonderful things, but they've gone from 90% of the GDP of America to 65. That's not because America did anything bad to them. It's their own bureaucracy, their own cost. I think the leadership, Merz, Macron, Maloney, Starmer, I think they know. I just think politics is really, really hard.
That was the JP Morgan Chase CEO, Jamie Dimon, calling out slow bureaucracy in Europe in a warning that a weak Europe poses a major economic risk. And we make no apologies for having played that yesterday or something around that theme yesterday and again today, because it does link into our next conversation, Guy, which is about how European finance tries to fight back. I mean, Jamie Dimon is very clear on what he thinks has gone wrong.
It's hard to argue with him on this. Europe clearly is a much more regulated beast than the American economy is. And you only have to look at the economic sort of outturn of that to figure out that actually this is having a fairly significant impact. I think it's really hard to argue with. So what are we going to do about it, I think, is the key question. On that note, let's find out. What are we going to do about it? Oliver Crook has somebody with him that may have an answer. Ollie, over to you.
Yeah, that's right, Guy. Jamie Dimon saying that Europe has a problem. Here to solve that problem, or one of the problems at least, of market integration is Maria Luis Albuquerque. She is the commissioner here in Europe for financial services and the Savings and Investment Union. Thank you so much for joining us this morning. We just heard from Jamie Dimon some of the sort of very common refrains we hear about Europe: over-regulation, not enough simplicity, and critically, not an integrated financial markets. Capital markets union, what we used to call it. We're now focusing on Savings and Investment Union. You've just presented your ambitious, you said yourself, market integration package. For us, just framing this, how important is it to get it through? And then I think critically, how close are you to making it an actual reality now?
Well, good morning. Thank you for inviting me to be here. It is very, very important that we do this. We have been discussing this element of the Savings and Investment Union, the Capital Markets Union, for over a decade now. So this is the time where we actually need to deliver. We have all agreed that we need a single market when it comes to financial services, because that's where the potential is. We need scale in financial services in Europe in order to get the necessary funding to the priorities we have in Europe. And for that, we need to eliminate the barriers. We conducted a very extensive consultation to the market, and the same problem keeps coming up again and again. It's all about fragmentation. So that is what we are trying to tackle here, fragmentation in the way our rules are being transposed, interpreted, and even supervised.
And one of the other critiques that we hear often of Europe is that it moves too slowly, particularly in a day and age when you see such speed, particularly within the United States. You yourself have said that we have no time to lose. We do not have the luxury of time to act. Talk to me about the next hurdles and the speed at which you'll be able to clear them. Regulation, for example, centralizing that. How much buy-in do you have there? What are the next steps to actually making that a reality?
Well, we've just adopted the proposal at the Commission level. Now we have to engage with the co-legislator, with Parliament and Council. I am hoping that both co-legislators share this sense of urgency. I have had the chance to explain the plan actually previously to its adoption, but still the broad lines of it with the European Parliament, the coordinators on the Econ Committee. It was very much welcomed and recognized as something that we really need to see done. I haven't yet had the chance to do it with Council, but I hope to do it later this week. And I really need to insist that this is urgent and it is very important that we deliver.
And in the spirit of that urgency and your most sort of ambitious and optimistic timeline, what does that mean in terms of actually making concrete progress, getting the stuff over the line?
Well, I think we should move to have this packaged, discussed and approved as early as possible so that we start implementing on the ground. I mean, ideally, if we could start implementing it by 27, I think it would be really great. It's a big package, so it's going to take some time to negotiate and get to a final agreement, but I think it's doable.
And so this is the legislation. Another side of this is, of course, the financial institutions, the banking. We got out of the United States their national security strategy. There was a whole section in that on preserving and growing America's financial sector dominance. Their approach, in large part, has been cutting regulation in the United States. The Bank of England last week lowered their capital requirements for banks. Are we prepared to talk about deregulation in Europe? I know last time we spoke you said you don't like that word, but yes. I fear that in the conversations in Europe, when we just talk about simplification, it doesn't really seem to strike at the heart of the scale and the urgency of the task for Europe.
Well, in the US, they talk about modernization, so they also don't talk about deregulation. They don't use the word. Well, the supervisors talk about modernization. Sure. That's the word I heard, but that's beside the point. We have committed under the Savings and Investments Union strategy to do a complete assessment of the competitiveness of the EU banking sector. We are already starting that work. We will be consulting with the market. We'll be consulting with the banks, obviously. We will be gathering information. We really want to understand where the problem lies and how we can fix it, what the problem is, because it's not just about our banks being competitive, it's also how they can support the competitiveness of the European economy.
So let's talk about some of the specific dimensions of that. For example, I'll refer to the UK again. They have boosted the cap on pay for bankers in order to boost competitiveness. Is that something that you would consider in Europe? Is that something that you would consider looking at? Is it on the table, at least for you, in discussions next year of review?
At this stage, we have nothing off the table because we are still conducting the assessment. So we don't prejudge what we are going to conclude out of this assessment. I think we should have an open discussion, understanding where the problems may be, and putting in place the measures.
Do you think that pay could be a problem?
It hasn't come up in any of the conversations I've had so far, but again, this is early days, but it hasn't come up.
And one of your frustrations, when we spoke about a year ago, you said bigger banks provide better services at lower cost. Obviously, bigger banks for Europe is one of the priorities. I was looking at the Stock 600 banking index, up 66% since Trump was elected, versus the U.S., up only 30%. And yet, we do not have bigger banks. How do we get bigger banks?
Well, we have bigger banks if from a regulatory perspective, we should get out of the way so that market-driven consolidation can happen. But it should always be a market-driven process. We will not be determining that banks should consolidate or not. We're just thinking that we would need some European banks, pan-European banks, with the kind of muscle that would allow us to actually compete also in the global scale. It doesn't mean that there will not be room for smaller banks. It depends on the kind of the services you want to provide and the part of the market you want to serve. But we should get out of the way. from the supervision, regulatory, and political perspective.
And one of the ways that you could potentially get in the way in order to get more of a sort of market, more market-respecting kind of banking sector within Europe, and you've talked about this, is enforcement action against countries that basically are, and I'll quote you here, that perpetuate business models which are not fit for the future. How intensely are you looking at that? Is that something that you're going to move on potentially in order to get the sort of market-driven consolidation we need in Europe?
Well, implementation and enforcement is part of our job. If we agree on the rules, then the Commission has to be prepared to monitor the implementation and follow up with enforcement if any member state for any reason does not comply with the rules. That is part of our job. It's not just agreeing on the rules, it's having them on the ground implemented properly.
Is that something, but are there specific examples you're looking at and that you could potentially move forward on?
We have launched recently 2 infringement processes in 2 European member states. It is a process which is never finished. We keep on looking at what needs to be done. And yes, enforcement is part of the toolbox we have to guarantee that we eliminate the current discrepancies among our markets.
Do you have a timeline on when you might have a view on those?
On the what?
On those investigations, on those things that you looked into?
No, this is ongoing,
Okay.
so there's never a specific timeline.
And I'd like you also, if you could help sketch for us, because the Capital Markets Union, or whatever you'd like to call it, integrated financial system within Europe, this is basically the highway, right, for capital to drive on. If in the absence of cars that can compete, does that not sort of set up a highway for a bank like JP Morgan, some American banks, to basically come in and eat Europe's lunch if you do not have the banks? Do you see that as the stakes for European banking consolidation?
I would say that the current fragmented landscape is benefiting mostly those banks you are mentioning, because given that they are bigger, they have more resources, they find it easier to navigate through our fragmented landscape, which is ironic, probably.
Yeah.
So it is not benefiting us. This somewhat prevailing protectionist approach that we can still see in some European markets is actually not helping Europe at all. And this is something that I have perceived from the many conversations I have with different stakeholders. So I would say that eliminating these obstacles can be a major element to support the scale-up of European actors providing the good services in our market. And we want to remain open, but we want to be competitive.
And another question I want to ask you about is about the frozen Russian assets. We heard from these sort of conversations over the last couple of days that the Europeans may be moving towards an agreement to unlock a reparations loan for Ukraine. From your perspective, in terms of financial stability, you think a lot about the status of the euro in the world, the European bond market. Do you believe that there's any risk in moving on that and basically threatening the haven status of the euro and these sorts of things? What kind of risks do you think are there associated with the move on Russian assets, and how do you insulate from those?
Well, I think that the whole market understands that Europe doesn't do this out of a whim. This is something that is the reaction to a very serious situation, which is an illegal invasion, a war of aggression from Russia towards Ukraine. So this is not something that would happen to any foreign holder putting their assets in Europe. This is a very specific situation, and that was already tested when we froze the assets back in 22. So I think that was the first and probably the most relevant test. And I think that the whole market really understands that this is not happening to anyone just because Europe wants to do it. This is a war situation that justifies exceptional measures.
Well, Maria Luisa Albuquerque, thank you so much for your time. That is the Commissioner for Financial Services here for the European Union on a litany of different issues. We'll have to come back and talk about cryptocurrency another time. Thanks very much, and back to you, Anna.
Oliver, thank you. Bloomberg's chief Europe correspondent, Oliver Crook. Really interesting. Lots of lines in there, Guy. What stands out to me, though, is if you're going to reduce fragmentation, you might get more pushback from populists within Europe, and that might attract the attention of the US administration, and we know where their support lies. Whether the US will be happy to see less fragmentation of the banking system is an interesting one.
The line that stood out to me was the fact that US banks seem more capable of navigating the European process and its difficulties than European banks do, which is an interesting question as to how they ultimately do that.
Coming up on the programme, the Fed is broadly expected to deliver a rate cut tomorrow. More on that next. This is Bloomberg.
Good morning. I do sometimes wonder if day one of the Fed meeting should be declared a markets holiday. Today certainly feels like it already is. Equity markets are doing absolutely nothing. Futures are doing absolutely nothing. The market, like a toddler, is holding its breath, waiting for something to happen a little bit later on. So equity markets, I have nothing to report.
No, they look pretty flat, don't they? Let's have a look at bond markets. They were exciting yesterday, Guy. Will they deliver again today? The German story, of course, hangs very much over this, as well as the Fed. The Fed, the big picture. The German story is that we're going to see next week approval of a large amount of defence spending. But is that already in the price? Had we already seen that coming? Certainly we're not seeing a huge amount of movement in the German curve today. You've got the 10-year on the screen there, and I can see that across the German curve we're seeing not very much activity in terms of it. Maybe a little bit more at the short end. In fact, no. I'll take that back, maybe not. So we aren't seeing a huge amount of response to that, but we'll certainly keep that story under review. It looks like it's going to be something that will support defence stocks at the start of trade. So let's get back to the Fed narrative and the higher yield narrative that seems to have gripped markets over recent weeks. Treasury yields climbed to the highest in more than 2 months following losses in most global government bond markets. It comes as the Fed policymakers begin their crucial two-day rate-setting meeting today. Let's go to Valerie Teitel, who has been focused on the Treasury markets and their link to the Fed. Val.
Well, look, we have seen quite a steep rise in global yields for the month of December. We came very close to hitting a 420 level on the U.S. 10-year Treasury yield. That's something we've not seen since the month of August. And it's very surprising given the last trading day of November. We actually traded as low as 395. So a near 25 basis point rise in the month of December for the U.S. 10-year Treasury yield. It's finally made its way to denting this equity market risk on sentiment. They had the S&P 500 snapping its winning streak. But I also want to talk about the repricing that we've seen on the U.S. front end. Now, we have seen quite a hawkish shift in what we were pricing in for the Fed in 2026. It was only back in the month of September we were pricing in 150 basis points of rate cuts from the Federal Reserve. We've pared that back all the way in half. We're now pricing around 75 basis points of rate reductions from the Fed. And you have to tie in the global narrative to this. It's not just been the repricing around the Fed. We've also seen it around the Bank of Japan. Markets are more likely to are pricing in more hikes from the BOJ. Also tie in the ECB. Yesterday, those hawkish comments from Isabel Schnabel now have the front end pricing around a 20% chance of a rate hike in 2026. So there are a lot of global factors at play pushing up these yields. I do want to add the context, the fact that we still have a lot of risk events headed into year end. Obviously, we have the Fed tomorrow, but given how fractured they are, could actually be the data next week that could really turn the dial on Fed pricing heading into next year. We have that delayed non-farm payroll report for the month of November and the delayed CPI report. These two things combined could actually be more telling from what we hear from Powell tomorrow.
OK, let's focus on a different angle of the Fed story. The Fed probably likes to think it's special, but is it different? This is the key question that everybody's grappling with right now.
Yeah, that's right. We're watching the Supreme Court proceedings around the firing of the FTC commissioner from earlier this year from President Trump. And I want to point out a very interesting comment that we heard from Chief Justice John Roberts, who is calling Humphrey's executor a dried husk. And why this is important is because Humphrey's executor is the main precedent that protects those at independent agencies from dismissal from the U.S. president without cause. At the moment, they need cause. They need a reason like misconduct, which is what has been alleged against Fed Governor Lisa Cook, for the president to fire them. If perhaps we do see Humphrey's executor overturned, this means there is very little protection in terms of independent agency heads versus the U.S. president. This opens up a very broad stance when it comes to how powerful the U.S. president can be over these independent agencies. Questions still remain whether the Supreme Court will still think kindly about the Fed being a special kind of independent agencies, but definitely overturning Humphrey's executor could make way into eating out that protection.
Valerie, great stuff. A really deep dive look into what we are seeing in terms of the Fed moving forward from here and its independence, potentially under pressure. Let's talk about what we can look forward to over the next couple of days. The Fed meeting, obviously front and centre. Yields have been rising. What is happening into year end? All of these questions are things that portfolio managers are watching very carefully. Chris Watling, global economist and chief market strategist at Longview Economics, joins us now. Chris, what would be a surprise today from the Federal Reserve in your book?
What would be a surprise? What a great question. I think a dovish cut would be a surprise, actually, because, of course, everyone's expecting a hawkish cut. Everyone's, we've been missing the data. We don't really know exactly what's going on in the US. There's an absence of data because of the delays post the government shutdown. And there's this sense of hawkishness. And as you've just articulated and Valerie's articulated, a lot of bond yields have been backing up around the world. We're starting to price in hikes in certain economies, in Canada, Sweden, in New Zealand. If you look out on the curve into 2026, they're pricing in hikes. And this is new. So I think if it's a dovish cut, actually, that would really surprise the market in a positive way, and I think that would be a great setup into year-end and into next year. But, I mean, the central expectation that strikes me now is a hawkish cut. So we will see, bizarrely, that it could be good news.
Why am I listening to the Fed today? They've got no economic data. They have no clue as to what is happening. Why am I paying attention? Valerie just pointed out there's much better data still to come. Why do I listen to the SEP and the dot plots and the Powell press conference? Why is that going to be important when I get to it tomorrow?
Well, I mean, liquidity is the most important thing in markets in a short-term basis. So in the long term, it's earnings and economic growth. But in the short term, it's all about liquidity. It's all about the Fed. I'd be interested to see what they say about reserve management. Do we get anything on that? The idea they might come back and start buying assets once again. Now we finish QT. I think that's a critical part of the sort of liquidity equation. And really everything they say about potential rate cuts in 2026, how they see growth, all of this, I think, is important. There's no doubt the US Fed is the most important central bank in the world by a long stretch. So everything they say is very important today.
Chris, good morning. Let me ask you about the link between politics and stocks, because we are not far from the midterms now. By some definition, we're going to be into the second year of the Trump presidency fairly soon, and I know that you've been looking at what that confluence of factors usually means for stocks, and I wonder how much the usual applies. This is a pretty interventionist US government.
Well, that's a good point. It's interesting when you look at the presidential election cycle. I mean, it's interesting how the second year of the presidential cycle is the tough year, and of course that's the year leading up to the midterms, in this instance 2026. And in fact, if you look back over 100 years, there have been an awful lot of very tough year twos in presidential cycles. In fact, even Trump's first term in 2018, we remember we had two big sell-offs. We had Volmageddon at the start of the year, and then we had the sort of Q4 2018 sell-off into Christmas Eve. So midterms are tough typically. Having said that, if you think about the sort of macro backdrop for global stock markets, for the US stock market, it really looks pretty good at the moment. I mean, as we said, we just talked about liquidity. We're getting rate cuts. We've got an economy that's growing in the US and globally. I think you're getting a global cyclical recovery in 2026. And that's a very good backdrop for stock markets. So, yes, I worry about the midterms, but actually I think the backdrop and the setup's pretty good.
And Chris, what do you make of concentration or lack of concentration in US stocks at this point? I asked this because I was reading yesterday some research by Bloomberg Intelligence talking about how they're encouraged that it turns out global stocks do not need their AI training wheels. And this references the fact that global stocks are actually not far from all-time highs at a time where many people have been having doubts about the early darlings of the AI boom. I wonder what that's been telling you about where tech goes next.
Well, I think what's interesting is we've witnessed a broadening of the global stock market, and that's kind of been our theme over the course of the last 6, 9, 12 months, that actually all these rate cuts you've been getting around the world are going to deliver that cyclical recovery and deliver that broadening of the global market. And there's a lot of countries around the world that are outperforming the US now. Spain's been a big pick of ours for the last year or two, and it's up about 50-60% year to date. It's significantly outperformed the US and indeed the NASDAQ. So, and there are lots of examples. You look at Chile, you look at South Africa. These are not AI countries. These are cyclical stock markets, and they're doing very well. So yeah, I mean, I think I like tech still. I don't think you need to get out of tech, but I just think there's this broadening. So there's other places you can go where there's alternative earning streams that are coming through as we get this cyclical recovery coming. So it's a fascinating stock market. It's a great looking beast at the moment, and it's nice to see it broadening and going beyond just AI, quite frankly.
Chris, a global cyclical rebound, does that come with inflation?
Well, inflation always lags, so it'll come with inflation eventually, but not to start with. I think inflation should be trending down as we get into the first half of next year. So the tariffs has distorted it, and I think that'll fall out the equation as we roll into 1H 2026. So yes, there's some inflationary issues down the line, and maybe that's what bond markets are starting to think about in the last couple of weeks. But actually, you know, you've got the growth first and then the inflation.
Does the inflation come before the midterms?
I don't think so. I mean, there's spare capacity in the labour market in the US. Really, inflation's picked up this year because of goods prices, not really the service sector. And I think there's some softness that we'll see there as we get into next year. So I think it should ease. I know it's a big political issue. It's important for the midterms, and it's a big focus of Trump. But I suspect not. I think inflation surprises to the downside in 26.
Okay, that's interesting. And would you expect then that long-end yields will start to fall, or maybe not entirely fall into line with what the Fed is doing? The Fed's always going to have more impact at the short end. But do you think that long-end yields are going to stay where they are, Chris, or are they going to start coming down as the Fed continues to cut interest rates?
Historically, say 10-year yields always trough around the time of the last cut from the Fed. So if that's the correct playbook, and if that's you know, following historical norms, then I think 10-year yields go lower. And then the other point is, if you look at the K-shaped economy, the bottom half of the US economy needs lower yields to get housing going, get the industrial sector going, and all that sort of stuff. So I think there's a good argument that you know, it's just a bit of short-term volatility.
Can I ask you what you see as upending the arguments and what could destabilize your view going into next year? It's interesting, Donald Trump is currently messaging, talking about what he sees in terms of the Supreme Court around tariffs and the fact that the Supreme Court could throw out tariffs. You've got the midterms, you've got geopolitics, you've got the AI story. What is it that you think could kick volatility higher and cause market turbulence in 2026? We obviously saw that with Independence Day in 2025. Could you see something similar in 2026 that completely upends the market, even if only for a short period of time?
Well, I mean, clearly, Trump and policy is always a risk, as you said, as you articulated on Liberation Day. I mean, that is always a risk. But I think, you know, we're keeping a close eye on these SOFR spreads, these secured overnight financing rates, the tightness, a bit of stress you're seeing in the credit market. That's a concern. A lot of tapping of the repos by deposit-taking banks and so on. There's clearly some stress out there. That's a big focus, feeding off that private credit story we've been thinking about. There's also very high levels of speculation in this market. So that is always a risk. It's very difficult to time a market on a level of speculation. There's no clear sort of sell signal. You don't know when it's too much. But there is a lot of speculation if you look at single stock call option volumes and margin debt. They're both very, very high. And actually the participation at the sort of top level of S&P volumes is really quite low. So it's kind of a bizarre market. We're sort of bifurcated with a lot of retail speculation driving it. So that does concern me, and that is definitely a risk. That could upend the sort of apple cart. I do worry about those sort of factors. But yeah, and look, and if we're wrong on inflation, that is definitely a big risk, because this market is living off liquidity and rate cuts, and if that story starts reversing significantly, then there's a bit of concern. And then I think the other thing I'd say, just sort of really left of field, is it's very bizarre to me that the Canadian curve and the New Zealand curve are starting to price in rate hikes when their house prices are actually still going down. In fact, if you look in, I think it's Canada, house prices are contracting about 2% year on year. So it's a very odd environment. You would have thought after all those cuts, Canadian housing would be turning up, not down. And in fact, even though it's turning down, you're getting hikes coming priced into the curve. So there's something slightly that needs keep a good eye on. We're very concerned about what's going on in the sort of periphery developed world, if you like. So, yeah, there's tons of stuff to worry about. There always is, but that's what bull markets are about. They climb a wall of worry. So, yeah, so
Chris,
we're watching all that stuff.
Thank you very much. Thank you for the confidence and thanks for the list of things to worry about as well. Chris Watling, global economist and chief market strategist at Longview Economics. Coming up on the programme, German defence stocks are called higher as Germany is set to approve a record €52 billion defence package. We also have no real progress on Ukraine. That also possibly in the mix. This is Bloomberg.
If inflation continues to be persistent and looks like it is not coming back down towards the board's target, then I think that does raise questions about how tight financial conditions are, and the board might have to consider whether or not it's appropriate to keep interest rates where they are or in fact at some point raise them. But I wouldn't put a timing on that. It's going to be a meeting by meeting decision.
That was Australia's Central Bank Governor Michelle Bullock. The RBA's board unanimously agreed to keep rates unchanged for a third straight meeting. And there was a hint of hawkishness there around inflation worries. That pushed up certainly short-end yields in Australia and the currency a little bit. Let's bring into the conversation our Markets Live reporter Skylar Montgomery-Koenig. Skylar, good morning to you. We've seen this sort of global hint towards inflation concerns. Yesterday it was the ECB, last week it was Japan, today the RBA talking a little about inflation. A previous guest on this programme was not worried much about certainly US inflation. How concerned are you around the inflation theme and the higher yield theme that seems to be building?
Yeah, I mean, certainly the higher yield theme, I think, is something to take seriously. This is actually pretty normal behavior for markets. So what you see is that the market looks for the hiking cycle that's coming next, well before the end of the cutting cycle. And that becomes easier because there's a shorter lag between the cutting cycle and the hiking cycle that comes next when there isn't this great economic damage, which we haven't seen. And you're also talking about inflationary pressures, particularly in the US. So I think there's different concerns everywhere, but I think certainly in the US you need to be worried about inflation heading into next year. And so you're looking for the hiking cycle before you get to the end of the cutting cycle. And even when you have that firmed up and when you expect the first hike, yields start to rise from 9 months before that. So I think certainly heading into next year, as you're talking about inflation potentially being higher in the US, maybe you get some kind of fiscal bill heading into midterms, you need to be talking about it. And you'll likely see that continued pressure upward on yields.
Is the Fed going to give us a clue today as to when that happens? Like, I'm wondering what the Fed can say today and tomorrow.
Yeah.
And what Powell... He sits down today and he goes, right, OK, guys, we have no data. So what decisions are we going to be making here? So is this a redundant meeting from the FOMC? I know everybody's very excited about whether it's hawkish or dovish or whatever, but I'm wondering how useful it is in terms of what it's going to tell us about what comes next.
I think it's useful because we're now moving to a type of FOMC where you're looking at what the individual members think and care about. So the meeting tomorrow, I think certainly because pricing is skewed so dovishly, you're ended up on the hawkish side. And what you're looking for there is how many dissenters are there. You're likely having one dovish dissent, but I would expect at least 2 hawkish dissents for a hold. Right. And you're also looking at the dot. So next year, is there still only 1 cut expected? So that gives you some kind of guidance on what to think. But I think certainly what you've also seen from the last 5 FOMCs is that Powell has corrected the market hawkishly in the press conference. So what you tend to see is the dollar sells off because the market wants to be dovish on the immediate reaction, but that ends up higher 3-6 hours later because Powell's more hawkish.
How do you think, Skylar, people should think about dissent at the Fed? We talked about this, quite a bit of a newer phenomenon. Other central banks, there's more history of dissent. Many in the market don't want to see a lack of independence at the Fed. So how should we think about dissent?
I think it's certainly a positive signal for independence because it means that you're not all coalescing around a Fed chair that maybe isn't as independent as you would hope for. And I think it means that you have more volatility next year, right? Because every meeting, people are taking individual views on how that economic data is coming in. And it means that you have more likelihood that you'll get kind of pinged around. And we certainly see it in the Bank of England, that a decision comes and what the dissenters are does impact how hawkishly it's taken, and you get more volatility as a result of that.
Bank of England is just becoming impossible to call at the moment. You do wonder whether the Fed's going to end up in a similar situation very, very soon. Skylar, nice to see you. Thank you very much indeed. Bloomberg's Markets Live, Skylar Montgomery Koenig. And remember, you can get all of the analysis, and it's going to be a big day today, into tomorrow, MLIB Go, on your Bloomberg terminal. Single stocks. Let's start with wind. Louise Moon, over to you.
Yeah, we're looking at wind in particular this morning. So this is after news overnight that a US federal judge has said that Trump's banning of new wind projects is illegal. So if you look at her quote here, quite a punchy quote from her overnight. So it's been a long-running issue this year. So Trump has been trying to essentially ban a lot of these wind projects in the US. This is now said to be illegal. So you would expect this, be a bit of a boost to some of these stocks this morning. Also, has had a bumpy ride this year on the back of a lot of this news. We expect it to kind of tick higher into the green, so that would be the main beneficiary of this in Europe this morning. Potentially also SSE and Vestas that we're also looking at. So wind is a key topic. Next up, we're also looking at defence stocks. That's after news from Germany that they're investing a record amount into their military. So 29 contracts. You can see it broken down here. 22 billion, for example, into basic military gear. So this is a real record, trying to create what they're saying is the biggest conventional army in Europe. So looking at the kind of classic stocks in the defence industry, Rheinmetall, BAE Systems, Saab, and also, of course, a host of others. They've already been benefiting from, this real rise in defence spending. So you'd expect them to, gain on the back of them again today. And then finally, ThyssenKrupp, also potentially on the back of that defence news, but also they had some results today, expecting to swing to a loss this morning. Quite a good year so far, up over 200%, but this could potentially weigh on that stock. And you can see from the analyst ratings that there's a bit more to be done for them. So that's another one that we're focusing on.
Louise, thank you very much. Our equities reporter, Louise Moon. Yes, we will certainly keep an eye on those wind stocks, certainly the defence names. Defence stocks were up yesterday on a lack of real progress on the Ukraine agenda, and that still seems to be the case this morning. So that combined with the German defence news, clearly a sector to watch. This is Bloomberg.
Tuesday morning, let's take a look at where we were yesterday in the US session. We kind of faded, actually, the story from the start of the day. We're basically into the kind of holding breath moment. If you take a look at futures this morning, they are showing you absolutely nothing. We're waiting for the Fed. In some ways, the Fed doesn't know very much, but I think it's worth listening to the Fed, despite the fact that actually we don't have much data to go on. I think what happens next is going to be important. Will it give us clues as to what comes next in 2026? Anyway, so that was the picture yesterday. We kind of went out there. We weren't too far different in terms of where the closing price was in the United States. So let's talk a little bit about now what the futures tell us. I wish I had more exciting news for you, because at the moment this is what the picture looks like. As you can see, we are in the holding breath phase. We are waiting to see what happens. Even the DAX, with all of the news surrounding what is happening with defence stocks this morning, is up by a staggering 0.2%, and I'm being generous here, I'm rounding up. And that's the picture, therefore, we find ourselves with. We're going to wait and see what gets delivered by the Fed. Other central banks are sounding a little bit more hawkish. Are we going to see a similar message from the Fed, or is the bigger risk actually that the Fed sounds dovish, and actually that tells us concerns about what is happening with the US economy? Anyway, there's a lot to play for over the next couple of days. I don't know how much news we're going to get, but it's certainly going to be fun to watch. Anna.
Yeah, let's have a look at some of the individual, well, I was going to say individual stocks. There's only one on my board, and then there are a couple of sectors that really are going to be in focus this morning. The wind sector certainly in focus. We've seen, of course, that Donald Trump's executive order banning new wind projects has been deemed to be illegal by a court. The defence stocks in focus, as you say, Guy, that big defence spending plan coming next week from the Germans. They're set to approve military procurement contracts worth a record 52 billion euros. And ThyssenKrupp also in focus, as this business says it's going to swing to a loss in the current financial year. Weakness in the auto sector and restructuring charges to blame, Guy.
OK, here we go. Big drum roll moment. I'm joking, of course. It's a small drum roll moment. We are waiting for markets to open here in Europe. Top down, nothing to see. Bottom up, I think there's going to be some interesting stories. I do actually genuinely think the wind story is interesting. What continues to happen in defence obviously is fascinating from a European point of view. Will it be reflected in the top-down market? No, the market is looking broadly for some clues as to where policy goes next. And I think until we get that, we may not sort of go very far. Volatility, remember, has come down over the last few days, though bond markets obviously remain reasonably elevated in terms of the yield. FTSE 100 is negative, the CAC 40 is mildly positive, the Stock 600 is mildly positive, and I'm using mildly really kind of quite buoyantly here. IBEX is up by 0.1%. I'm not entirely sure that the German market is going to play ball this morning and open early, so we're going to have to wait for that to happen. But while we wait for that to happen, there's some single stocks and maybe some sectors that are worth focusing on. Anna, over to you.
Yeah, absolutely. Let's go to where the sector movement is in the first part of the trading day. Financial services, actually the best performing sector, up by 0.6%. We actually see Man Group as one of the stocks that's on the rise within that. We're around 50-50, gaining sectors, losing sectors. At the bottom of the basket, if you like, we've got basic resources, and we have seen some weakness coming through in steel prices and other basic metals overnight, so maybe that's having a negative impact there. We've also had some news flow surrounding some M&A in that space. We'll watch that. But one of the sectors that we mentioned in the run-up to the open is showing some signs of life, and that is the wind sector. We've got Vestas up by just shy of 3%. We've got Ørsted up by 3.4%, and of course this all in connection with President Trump's executive order being declared by a federal judge to be illegal, saying that, and this was seen as something that could be positive for these businesses that had great plans, particularly around the eastern seaboard, that had to be either mothballed or cancelled entirely. So that's where we are. In terms of the individual movers, we've got Novo Nordisk moving higher, Relics moving higher this morning, HSBC providing some downside movement. But yeah, still waiting for Germany, to answer your earlier question.
I'm actually struggling to see any kind of clear narrative in terms of the stocks that are moving this morning. Oil stocks maybe a little softer. We have seen obviously a big move lower in the oil price. Maybe that acts as a bit of a drag. So you are seeing names like Shell under a little bit of pressure, but not a lot of pressure. It's British American Tobacco, HSBC, EssilorLuxottica, Swiss Re, Richemont. Some of the luxury names are actually a bit soft. So LVMH is also a little bit soft this morning. But again, not by much.
We do have those defence names just coming springing into action over in Germany now. So we've got Renk Group up by 4.3%. Some of the others within that space, industrial goods and services, of course, it forms part of that. So Hensoldt is up by just shy of 3%, Rheinmetall. And it's the confluence of the German spending. I mean, maybe we knew this was coming, but it's another tick in the box for the process of delivering huge uplift in German defence spending, plus the fact that we've got just more talks on Ukraine overnight as the message, and some progress but no sort of resolution. Maybe that also leaves some space for these German defence names to go
even
higher.
with this, the DAX is up a staggering 0.2%.
Yeah.
Which kind of speaks to the idea that we are maybe kind of waiting for the Fed. And it's also interesting that actually it's some of the pharma names that are doing the kind of the most heavy lifting across Europe. So you've got Astra, Allianz, Novo Nordisk, Rheinmetall in the mix at the top end of the market this morning. There's plenty of politics that we need to focus on as well. Look at what's happening in Germany, look at what's happening in France. There's things that are worth paying attention to. But how are we now thinking about what 2026 is going to deliver? And is the Fed going to give us any clues today as to what the story is going to look like? Madison Fowler, JP Morgan Private Bank Global Investment Strategist, joining us this morning. Good morning. You excited about the Fed?
Always excited about the Fed.
Is the Fed going to tell us anything useful today? Why are we excited about the Fed? Obviously, it's a Fed meeting. We need to pay attention. The Fed doesn't have much data going into this meeting, and we're about to have a Fed chair shift. We're going to get a lot of dissent. So I'm just kind of, which bit should I be excited about? Because in some ways you shouldn't be excited, but in some ways, with this level of dissent and this level of uncertainty, there's a lot to play for.
Well, I think there's reason to be excited for the fact that we will receive, incremental clarity on the path of future interest rates. So when we think about the fact that there might be a high bar for future Fed rate cuts after this one, I think that does signal to us what the path of 2026 could look like. And so if we do see more pronounced dissents, for instance, in this meeting, that could signal to us that the Fed might be more cautious heading into 2026. But nonetheless, I think it is still clear that even with that, the Fed is maintaining its easing bias. But I'm very interested to hear not just about the short term, but also the long term as well, and how it perceives the neutral rate and the trade-off between, for instance, AI productivity-linked gains, but also some of the challenges related to fiscal activism and how that really shakes out, I think will be important as well.
What would you ask if you had a question to the Fed, Madison, today? And everyone will be focused on, obviously, the dissent question will be front and centre. But you raised the AI story and productivity. And if we are focused on the longer term and what that can really deliver for the US economy and the global economy, I mean, what is it that we want to understand about the Fed's thinking on AI? Because we had lots of interesting conversations last week about the way that AI and inflation are going to interact, and maybe there'll be a mismatch in timing there. Maybe you get inflation first, then deflation, or maybe the reverse. I mean, what kind of questions would you be asking around that?
I think when it comes to the long term, and when we're trying to think through the balance of both AI and inflation, I think the biggest thing to try to understand is what does that ultimately mean for growth in the U.S. and also, you know, more broadly globally. So is there the belief that AI can lead to genuine productivity gains? And I think from our perspective, that answer is certainly yes. We are believers in the AI revolution. I think that doesn't mean that there aren't going to be pockets of froth and some consternation underneath the surface, and there will be winners and losers within that. But I do think understanding the strength of the potential productivity that could bring is quite important. And then, of course, what the path of inflation looks like as a result. So we do think that, you know, AI can have a deflationary impact, but at the same time, we know that there are more structural inflationary drivers as it relates to persistent capacity gaps, immigration controls, and all of that leads to higher structural inflation as well.
And what's the AI trade of 2026 going to look like then, with all of that in mind? Is it going to be, maybe it's not going to be about the early gainers, the companies that did really well in the first couple of years of the AI revolution? Is it going to be something different? We talk a lot about other sectors getting involved. Energy is the obvious one, other infrastructure. What's it going to look like, AI 2026?
I do think that we start to talk about that trade broadening out from here. So, and we're already starting to see more market discernment when it comes to even the big AI names. So, for instance, when we're just thinking about the trading of some of the hyperscalers, we are seeing markets start to, try to price in real time which of those names are going to see real revenue gains as a result of all of the capex spending that they've employed. So, I think that we want to be discerning around the hyperscalers, but we do expect that to broaden out, one, into the data infrastructure providers, two, into the power space. So you can think utilities there, those that expect to benefit from productivity enhancements, and there you can think like sectors like financials, even healthcare. But then I would also say that a lot of the value creation that we're seeing today is actually happening in private markets. Actually, some of the largest companies, both in the U.S. and Europe, call it between 85 to 95% of those are private today. And so when we think about that next wave of value creation, I do think we need a barbell, both public and private markets.
A lot of people are making asset allocation decisions for next year right now. They go to meetings, and what I'm hearing is that a lot of people are going to continue to allocate to private credit, private markets. Is that the right decision?
For private markets broadly, I do think it's important, especially if you are concerned about some of the rising concentration risks that we are seeing within the public market space. And again, when we think about the growth drivers of the future, I do think that allocating to private equity is important. When it comes to private credit, I think it's just another reminder of why very careful manager selection is so important. I do think when we're looking at the space broadly, there are some more reasons to be more mindful, I think, into the years ahead. But from a broad perspective, we are still seeing quite low default rates.
So some managers are, you think, maybe being a little too gung-ho in that space?
I think that ultimately it's really important to ensure that you are investing alongside managers that are being mindful of the underwriting standards, the underlying fundamentals. And when we allocate to any market, but especially within private markets, we do see that the dispersion between top and bottom performing managers is quite wide. And so I think that thoughtful manager selection is really important.
Okay, and thinking about, you mentioned in your notes, Madison, about fragmentation and how that throws up opportunities. I mean, we had a conversation about European fragmentation earlier on in the programme, which feels like a negative, that actually the answer is more pooling of interest, more capital markets union, savings and investment union around Europe. But you think about fragmentation as an opportunity because we live in a less globalised world, so that means more countries doing things for themselves, I suppose.
Ultimately, yes. And I think that's true across the board. So whether we are talking about AI inflation or fragmentation, there is a sense of the challenges bringing pressure, but also the promise of opportunities that are opening themselves up. So when we think about a more fragmented, more fractured global landscape that is, moving through more difficult supply chain issues, that's also led to, I think, increased fiscal activism. So governments spending more, corporates investing more heavily in capex, and we're certainly seeing that in Europe specifically as it relates to infrastructure and defense. And then, I think, again, bringing it back to the AI story, that's even becoming more of a matter of national security as well. So I think as countries are turning more insular, that opens up the conversation, I think, of global diversification and why that's so important because of that domestic story, I think, really burgeoning and that narrowing of the differential between the U.S. and the rest of the world into the years ahead.
Yeah, no, that takes us to the defence theme and that and the reshoring theme. Plenty of ways in which that fragmentation, the less globalised nature of the world.
Emmanuel Macron was talking just about this when he was referencing China yesterday, talking about the idea that unless China figures out how to make the relationship more balanced, then maybe they have to go down a similar road to what we've seen in the United States. Madison, thank you very much indeed. Nice to see you. Madison Fowler, JP Morgan, Private Bank, Global Investment Strategist. Looking ahead to 2026, let's look ahead to what we are seeing in the markets right now. Defence stocks catching a bid. You can see that with Rheinmetall, but you can see it across the entire sector. Luxury under a little bit of pressure. It's interesting that ASML's not doing very much, despite we've got that good news, apparently, from an Nvidia point of view on the H200s. Anyway, let's focus on the defence story, because that is the standout theme in Europe this morning. Louise Moon with more.
It is indeed the standout theme. So looking at Rheinmetall, BAE Systems, Saab, Leonardo, all of them across the board ticking up into the green in early trading. That's, of course, after Germany investing a record amount into their defence contracts. So we're seeing this across the board, all across, straight into the green for them, extending gains that we've already seen this year. Moving on from that, we're also looking at ThyssenKrupp, taking a look at their stock down over 13%. That's as analysts are focusing on their guidance rather than the beat in their results. Their guidance for the following year wasn't so strong, and that's what investors are really looking at this morning. Moving back to the UK, also looking at British American Tobacco, the tobacco giant. Their stock down over 4% into the red. They had their results this morning, and they cut their revenue guidance just slightly. They were seeing it at the high end, now seeing it slightly lower for the following year. So stock is reacting on the back of that for BAT. Now, moving into wind, obviously this is a big story after a US judge ruled that Trump's banning of new wind projects was illegal. So this is benefiting Ørsted, Vestas, both taking up high into the green. Ørsted up over 2% this morning on the back of that. So positive news for them. Potentially some new projects could go ahead in the US. And then finally, looking at HelloFresh, down over 6% this morning. That's after there was cut by Morgan Stanley, saying that there's a lot of competition in the US in the market. And so, the prospects for future growth are not a bit more shaky than potentially previously thought. So weighing on their stock today.
Louise, thank you. Louise Moon from our equities team with those stocks that are moving this morning. Up next, we'll continue to focus on the European defence space, including Rheinmetall, after Germany approves, or is set to approve, next week, a record 52 billion euros in military orders. That's next. This is Bloomberg.
Good morning. How are you feeling? Welcome back. You're watching the opening trade. We are 17 minutes into the equity market session, and you are actually seeing some outperformance coming through from Germany this morning. The defence story is front and centre. It is driving that market, and it is causing the DAX to be up by, let's call it 0.5%. I'm being slightly generous, but let's call it 0.5%. Elsewhere in Europe, nothing to see here. Very quiet markets. Quick look at the defence stocks that are doing all of this heavy lifting this morning. Remember, many of them are in Germany, but not all of them are in Germany. Rheinmetall, Hensoldt, Renk, Leonardo across Europe, all moving higher, but BAE Systems is also on the upside. Some of the adjacent names are also moving to the upside as well. But this is German military spending that is likely, we think, to be announced next week. 29 military procurement contracts. We think the number is, let's call it circa 52 billion euros. we were anticipating this was going to come through at some point. It's just that it's interesting on the timing and kind of the size and scope of what we are seeing here. So let's get the details of what we know, what we're expecting. Let's go to Oliver Crook, our Chief Europe correspondent, who joins us today from Brussels. What do we know? What are we going to get next week? We've got a big procurement drive coming through from the Germans. They are accelerating military spending. What do we know about that military spending?
This is the Germans really putting their money where their mouth is. This is part of the sort of Zeitenwende. This was the famous speech given by Olaf Scholz after the invasion of Ukraine, the turning point for the German military and their view of their own military and the military capacities really being brought into life by Friedrich Merz now with this latest procurement, which is 52 billion euros worth of military orders. And just to put that into context, Guy, the German military budget in 2021, the year before the Ukrainian invasion, was 47 billion euros. That was the entire military budget for the entire year. So we're talking about a single order that goes beyond that. As you can see there, it's going to be a lot of it's going to be on basic military gear, about 22 billion, 4 billion on infantry and vehicles, 3 billion on interceptor missiles, and also that Arrow program that we'd heard from the getting from the Israelis, and about 2 billion there on surveillance and satellites. We should say that this obviously is one of the sort of most biggest drivers within all of European defense spending. This is super important for companies like Rheinmetall, which is up about 2.5% this morning, because it gave them the confidence to make the kinds of investments that Rheinmetall needed to make. 13 different factories, doubling, tripling capacity at a number of these plants. That's what the CEO told me last week. And that has been one of the major issues, actually getting these contracts in. And in order to get these sort of upgrading in terms of capacities and building out this actual stuff, the German companies need that kind of confidence. And it's very clear that the German government is giving that confidence. That is one thing. We have one side of this equation, which is the materiel. There's a difficult other side of it, which is the personnel. This is the question of the number of people within the German military. The German military stands at only about 180,000 active military troops at the moment. When we think about Russia, that's over 1 million. For the Ukrainians, that's approaching 1 million. So that is going to be the next step and potentially the choke point for the German military. But as it stands, this is really the Germans executing on those ambitions, those big ambitions of military buildup.
And Oliver, sticking with the defence theme, we've also seen, yes, some conversations, many conversations taking place around Ukraine at very high level in Europe over the last 24 hours, but not a huge amount of progress. But there has been an indication that maybe more unity has been found around security, around the frozen Russia assets and the use of those in backing a loan to Ukraine for the rebuilding of Ukraine. But is Belgium on board? I mean, that's been the stumbling block for some time, as hundreds of billions of dollars are in Euroclear.
Yeah, so that's the big question. We haven't heard anything particularly positive from the Belgians over the last weekend or the last couple of days. You know, the last thing we've heard publicly from them is saying that they basically had great misgivings about it. They were not yet on board with the plan. That being said, what we heard from European leaders with that degree of confidence came yesterday after that meeting between Keir Starmer, Zelensky, Friedrich Merz, and Emmanuel Macron. And Friedrich Merz had been in Brussels having dinner with the Prime Minister of Belgium just on Friday, right before going to those meetings on Monday. So it's quite possible that he had a bit more insight, a bit more success in lobbying the Belgians in terms of making forward progress on that. And really what the Belgians are asking for, I think, is fairly reasonable, that they share the burden of potential litigation or having to repay the loan if that were to have to materialize across the EU 27 or the EU 25. The other sticking point is, of course, Hungary and Slovakia, who have sort of raised objections about this. The Europeans will be able potentially to get around them by a qualified majority, so that's potentially is going to be put to rest. But really, this is the crunch time. Over the next 10 days, they need to come to a consensus on this. This is what we'll be talking to finance ministers about later this week. And really, the big event is next week for the European leaders meeting that will be taking place in Brussels. And we should say that in my conversation with Volodymyr Zelensky a couple of weeks ago, he was very unequivocal about the importance of these Russian assets. He says for the Ukrainians, this is a matter of survival, and that 90 billion euros will go basically 2/3 of the way of funding not only the Ukraine military, but their own other budgetary issues for the next 2 years. So absolutely critical. Even if you're really concerned with getting a peace deal across the line, it's the difference between sitting across the table from the Russians with $100 billion in your bank account and not having it.
OK, Oliver, thank you very much. Bloomberg's Oliver Crook in Brussels with the latest on the German defence push and the Ukraine news. Let's pivot to the tech sector, where Nvidia is making gains in after-hours trade after winning President Trump's approval to ship its H200 AI chips to China in exchange for a 25% surcharge. It paves the way for the chipmaker to potentially regain billions of dollars in lost business from a key global market. Bloomberg's Jill Desis joins us now from Hong Kong. So, Jill, we saw Nvidia trade higher in after hours on the back of this. I mean, this could be quite significant, I suppose. It's not the top-end chips, but it is a market that Nvidia counts on no revenue from right now.
Yes, that's right, Anna. And as you said, I mean, we're talking potentially billions of dollars in revenue that could be on the cards here. Just look at what Jensen Huang said a month ago, talking about China is a $50 billion market. So you're looking at absolutely massive potential here, even if you're accounting for that 25% surcharge. I mean, the fact that Nvidia has been unable to sell any chips to China over this past year as these tensions have persisted, I think does tell you that, if all sort of just goes ahead as planned, if they're able to sell these chips there, if China ends up buying these chips, I think that you're looking at a really, really significant opportunity for Nvidia.
Okay. Persuading Trump might be the easy bit. Persuading Xi could be the hard bit. Is China actually going to want to buy these things?
Well, Guy, I think there's a couple of things to keep in mind here. So these H200 chips, they're actually quite a bit more powerful than the H20 chips that were originally in question earlier this year that Nvidia was trying to sell to China. In actuality, the H200 chips are about a generation ahead of anything that the local Chinese chip makers like Cambricon or Huawei are able to produce right now. So you've got that as one factor, is that these are just more advanced chips. The other factor is that at present, China actually needs more chips than any of those local producers are able to supply. So when you take that into consideration, I mean, yes, it is true that the Chinese government has been trying to convince China to wean itself off of American chips, has been dissuading the purchase of American chips, but at the same time, I think, so the actuality there of being able to purchase an advanced chip that those local chip makers can't produce yet, I think is a pretty big draw here.
And I suppose we think then about what it is that President Trump is going to want from China in return for allowing them access to these H200 chips. We know what he wants from the US businesses exporting, and that's money, because that's what Nvidia and AMD and anybody else is going to have to pay to the US. But what does he want from China? Do we have any sense?
Well, Trump just said that, after talking, he said he was talking with Xi recently, that he's under the understanding that China could potentially be buying more U.S. soybeans, that entire agricultural sector that's been something that's really been at the center of a lot of these U.S.-China tensions this year, and China, going through, the prolonged period of not purchasing any U.S. soybeans before agreeing then. So Trump is saying that, that's maybe one thing that he can get from the Chinese side of things here. Maybe, ultimately agriculture is where he sees his big win.
Yeah, you wonder how much this could all change and how quickly it could change and how volatile it could all be. It's going to be an interesting 2026. Jill, great stuff. Thank you very much indeed. Jill Zesis on what is latest with Nvidia. Let's talk about some of the stocks that we're watching here in Europe in a bit more detail. ThyssenKrupp is under a little bit of pressure this morning. The numbers actually this time around aren't that bad. It's the outlook that I think is causing most concern right now, and what is happening in terms of the cash position of this business going forward. Costs are a huge factor, and that is being reflected this morning in terms of the weak guidance that maybe we are seeing being delivered. So the stock is down by, what, 6.25%?
Yeah, absolutely. So the stock responding, as you say, to that negativity around the guidance. It's interesting. It's the steel units doing OK if you're looking at the year-on-year performance here. But there's a lot of concern around autos. It's auto technology that's down 24% year-on-year. Materials services also down 35% year-on-year. So those are the areas, those are the parts of the business where they're having this weakness. I mean, the weakness of the auto story is a well-known one.
It certainly is. And are we going to see that converted into maybe a military story going forward? There'll certainly be some suggestion around that. Up next, we're going to talk about what is happening in Abu Dhabi. It's Finance Week there. We're done with the Formula One. We're on to Finance Week. We're going to check in on the private credit landscape. Direct lending is a big story. Golub Capital CEO Lawrence Golub is going to be joining us next. This is Bloomberg.
This is the opening trade, 30 minutes into today's session. Tuesday morning, this is what we have for you across European equity markets. Then up by 0.2%, not much, but better than we'd anticipated maybe an hour ago on a Fed day. We're waiting, of course, for the Federal Reserve, or day one of the Fed, I should say. Of course, they give us the results of their deliberations tomorrow. The DAX is up by 0.4%, and some of that is around the government spending, in particular around defence. We've seen defence names pretty strong this week, in part due to Ukraine news flow and also due to these defence lines coming coming through from Germany and the spending commitments that we're expecting to see nailed down there next week. The French market up by 0.2% ahead of a crucial budget vote, and the FTSE 100 underperforms this morning. Guy, what have you got?
OK, 3 is bigger than 2. That's what I've got. Markets are a little bit higher. I know that doesn't take into account weightings, but basically we've just got a few more stocks that are higher than lower. The defence names are certainly helping. London may be a little bit of a laggard with some of the oil names, a little softer. Volume is down. It's Fed day 1. Let's park that and move on from that. Let's talk a little bit about some of the leaders and see what has happened. Yeah, defence names are on the front foot after the Bloomberg story. Rheinmetall is up by 3.4% on the back of the spending plans we're expected to be announcing next week. BNP Paribas is climbing quite nicely as well, 1.7% to the upside. Orsted, the wind story in the United States. A judge maybe pushing back against the Trump administration's ban on East Coast wind farms. That certainly is helping out Orsted this morning. So that's kind of the positive story. Let's turn to what is happening on the negative story. There seem to be outlooks for next year that is causing a few problems at the moment this morning. British American Tobacco, outlook. Market doesn't like it. Stock's down by nearly 5%. ThyssenKrupp, outlook. Market doesn't like it. Stock's down by 7.72%. HelloFresh is actually a downgrade, I think, by Morgan Stanley. Its outlook for next year is that we're going to see more competition in the United States, and as a result of which, that stock is down by 7%. So it's looking forward into next year that seems to be causing a few problems at the bottom end of the market this morning. BAT, Thyssen and HelloFresh all weaker on the back of that, Anna.
Guy, here are some of the other stories we're watching this morning. The French Prime Minister, Sébastien Lecornu, faces a key vote on the social security budget today. The risks fueling political turbulence in Paris, the National Assembly will vote on a bill which covers spending on welfare, health and pensions for next year. Google is being investigated by the European Union over whether it has abused its dominance by using its own artificial intelligence tools to squeeze out competition. The Commission said today it will look at whether the firm has distorted competition by imposing unfair terms on content creators and giving its own AI model an advantage over its rivals. And President Trump's son-in-law, Jared Kushner, has emerged as a player in Paramount's fight for Warner Brothers Discovery just days after Netflix agreed to a deal. Paramount is making a hostile $30 a share cash takeover bid for all of Warner Brothers. Financing terms unveiled yesterday show that Kushner is participating in the Paramount bid through his investment firm Affinity Partners. Guy?
OK, let's turn our attention to what is happening in Abu Dhabi. Finance Week is on. The Formula One is over. Bloomberg's Abir Abu Omar joins us now from there. Over to you.
So this is the second day of Abu Dhabi Finance Week, where we have been over the past couple of days speaking to a lot of the executives that have come to the region. And joining me now is Lawrence Golub of Golub Capital. Lawrence, lovely to have you with me today.
Great to be here. Thank you.
Let me start with a quick question about your company's philosophy. Now, you brand yourself as good boring, which is in fact a good thing when it comes to your line of business. But in the light of the geopolitical tensions that are happening across the world, whether it is in the US or Europe or even here where we are in the Middle East, does that philosophy shift a little bit? How does that factor into how you think about what you do?
In our core business, which is acquisition finance, direct lending, it doesn't shift. It's good boring. We want to have partners who are equity holders, usually private equity firms, who are very skilled, careful, have a lot of money junior to us. We want a lot of resiliency in terms of things that can go wrong. But we do have to pay attention to what geopolitical issues or international issues or local economic issues might bring to bear big risks. And that brings in our second part of our philosophy, which is really to be specialists in credit, specialists in acquisition finance. So we specialize to be able to be boring.
So let me talk a little bit about what is happening when it comes to the monetary policy. Now, with higher for longer rates, where are, do you think, the best returns when it comes to risk-adjusted investments?
Well, I think I would urge investors not to look at the very short term. Don't worry about whether this 25 basis point cut is going to be followed by another one immediately or not. Forward curves show SOFR coming down to about 3% by this time next year. That rate is sustainable, good, attractive if we, on a dollar basis, have inflation under control. So a 3% SOFR rate, if we've got 2% inflation, maybe even 2.25% as we have some short-term adjustments from tariffs, that's all a real indicator of stability, and you know, we really like being floating rate investors because we don't have to guess about longer rates. But I think you'll be able to see, we'll all be able to see what the impact on longer term rates are from this lower for longer, or however it ends up, if long rates, for example, the 10-year Treasury is slightly over 4%, if that ticks up, that could have an adverse impact on growth rates in the U.S. We are very satisfied with the growth that's going on in the U.S. economy right now. It's not booming growth, but it's better growth than we expected when we understood the tariff implications. We do a quarterly report looking at our monthly financials all through the portfolio, and we don't see any indication of a base level of growth slowing down.
Right. Let me turn a little bit towards this part of the world. We are in Abu Dhabi at ADGM. You just recently got your license to operate here. And I've been asking this question to a lot of the people that we have been meeting with over the past couple of days. Why Abu Dhabi? You know, there's a lot of capital, a lot of people, a lot of operations that are moving to this part of the world. But where do you see the pockets of opportunity when it comes to the Middle East or the Gulf in general?
So we've had investors from the Gulf and from Abu Dhabi and the Emirates for more than 10 years. We decided a couple of years ago we wanted to open an office locally to be closer to our clients, to demonstrate our long-term commitment, because we're being asked to. And I think that connectivity with people in government, people in the business community, has really accelerated our growth in the region, not just in Abu Dhabi, but in the Emirates generally, and even in Kuwait and Saudi. I think that we're going to expand our office very significantly next year. Interestingly, nobody ever comes to the office. It's about having an office and having local people and being engaged in the community, philanthropic work like we do with NYU Abu Dhabi Stern. And it's not easy to just pinpoint, okay, because we opened an office, we got this investor or that investor. It's really about being part of the community. And we are also developing over time strategies to invest, not just invest back like philanthropy, but actually create investment strategies that take advantage of the growth of the economies here.
So we were talking about this before, earlier before this interview, and we were talking about direct lending and private credit growth in the region. And I asked you a question about, again, the pockets of opportunity that you're finding in the region when it comes to private credit. In Saudi in particular, we were talking about how private credit notions are on the rise. Do you see that the market is in the Middle East ripe for this kind of sophisticated vehicle?
I think it is becoming very ripe, but not in the way we might have anticipated 2 years ago. 2 years ago, I would have talked about how we would by now be doing acquisition financing for middle market companies, and there are opportunities here and there for that, but it's not really a scaled business based on the private equity industry having not developed as much. We do a lot in some of our other strategies of partnerships with banks, whether that's through CLOs or SRTs, which are synthetic risk transfer. These products are perfect to help Saudi banks expand their lending capability, and we're actively exploring, in parallel with changes in the regulatory environment to enable this, to be partners with some of the financial institutions in Saudi and hopefully also in the Emirates. So that's going to be, I think, a real opportunity for us and investors of ours.
Let me turn a little bit inward, and as an independent credit manager, will you, do you think, at any point be open to negotiations with larger players on consolidation efforts?
Well, we have a number of minority passive investors, and we've used that to build our balance sheet. You know, it's public that KIC, one of the Korean sovereign funds, and Mizuho, the large Japanese bank, are minority investors with ours, and we have important joint ventures with both of them. We're pretty dedicated to staying as an independent, boring specialist in credit. We don't want to be spread all over the place. We're best in sponsor finance. We want to be best in the adjacencies to sponsor finance, like working with banks on these structured products, and we're very happy with that.
And just finally on private credit again, and as it becomes something that is talked about a little bit more often, we've been hearing a lot about private credit, especially over the past few months, and how it's on the rise if it replaces traditional funding, traditional banking. Do you see, and going back to your point about regulation, do you think that regulators will eventually have to step in, and would that be healthy for the macro markets?
Direct lending and our relationships as an industry with banks actually reduce risk, don't increase risk. Banks have just as much money invested indirectly in acquisition finance and private equity finance through their loans to BDCs, through their loans to other private credit managers. But they're at the top of the capital stack. So just like we, as part of our culture of being boring, want to have the private equity firms own the bottom half, we are responsible for the first risks and the second risks and the third risk. So banks are really a lot more secure, and they make a lot of money on a capital adjusted Basel III, Basel IV basis. It's very profitable to lend to firms like ours and BDCs.
Lawrence, thank you so much for joining me today.
Thank you.
Lawrence Golub of Golub Capital. Anna, Guy, back to you.
Abir, thank you very much. Bloomberg's Abir Abu Omar in conversation there about credit markets, private credit markets, part of that conversation, and thinking about risks and where they might lie. Now, staying with the credit markets, hosts of the Bloomberg Odd Lots podcast spoke with Dan Iverson, the CIO of PIMCO, who is warning of dangerous assumptions where inflated credit ratings may be giving investors a false sense of security.
It is very, very dangerous to assume something has an investment grade rating just because the rating agencies assign a rating to it. It's critically important that you do your own credit work.
Those are the views then, Guy, of Dan Iverson, saying that you shouldn't just believe what you get on the tin from the credit rating agencies. And he's drawing the parallels with the GFC and saying, you know, at that point, you really shouldn't have trusted. Everything that was sliced and diced was AAA.
We've seen this movie before.
Yes.
2008. We've seen this movie. Are we about to see a rerun? And the point he's making, actually, is that regulators don't like to bail out businesses that have already had one bailout twice. So maybe the protection that has existed in the past for kind of expanding certain areas of the financial markets maybe don't exist for this particular area of the financial markets going forward. So watch out. So if you're not going to do your due diligence, don't expect the regulator to be there and help you out.
Yeah, that is interesting. And the links you have into the real economy and the rest of the economy could be material in the thinking of those regulators and whether they do get involved.
So what should we be worrying about more? Is it an AI bubble, which is kind of 2000, or is it 2008, which is the private credit bubble? There's two choices going into 2026. Up next, we're going to talk about what is happening maybe over in France today. The French Prime Minister, Sébastien Lecornu, faces a key vote on the social security budget today. It doesn't completely kill the finance package, but it could hold it below the waterline were this not to go through. We'll deal with the details and find out why it's important next. This is Bloomberg.
Welcome back to the opening trade. 8:46 in London, 9:46 if you are in Paris. We are seeing modest gains across European equity markets, waiting for the Fed, digesting a lot of news out of Germany. We also look ahead, though, to a crucial vote taking place in Paris today. The French Prime Minister, Sébastien Lecornu, faces a key test later today. The National Assembly will vote on the social security budget, which covers spending on welfare, health and pensions for 2026. We're joined now by Bloomberg's Caroline Conan, who's now back in Paris and can give us some information here. So how significant is this vote then, Caroline? I have lost count of the number of crucial votes that this Prime Minister has had to take to the Assembly.
You're not the only one to have lost count, really. And this is, again, perhaps another moment of truth for Sébastien Lecornu. We had the very, very tight adoption of the revenue chapter of that social security bill on a Friday night. And today we get the spending part and the overall social security bill voted at the National Assembly after being back and forth between the Senate and the National Assembly several times. That includes, again, the suspension of the pension reform that the socialists wanted to include. Remember, there was a precondition for them to support this bill. So the socialists, fortunately for Sébastien Lecornu, have called to vote in favor of this bill. However, we are seeing cracks within Macron's camp. The centrist party horizons of former Prime Minister Edouard Philippe, himself a candidate for the next presidential elections in 2027, is saying he can't vote in favor of this bill now, and he is calling for his 34 MPs to abstain. The Republicans, who were also supporting Lecornu before, remember, may also abstain. So even if you get some of Macron's camp and and some of the socialists, it might be really, really tight. The National Rally and the far left will vote against this bill. So we may see either a very, very tight vote or a rejection of that bill. Another back and forth between the Senate and the National Assembly with really no compromise in sight.
OATs are 72 basis points over bunds right now. I just point out the BTPs are 70. We'll park that thought for the moment and talk about what happens next. Should the market be worried? It was only a few months ago we were trading 85 over Germany. Is there a danger that we go back to those kinds of levels? What are you hearing from the market?
In the very short term, you know that Le Cornu is not using this constitutional article 49.3 to put his responsibility on the line. So there is not going to be any government collapse today. There is not going to be any Le Cornu resigning over the next few days. So the level of risks that we are seeing is not the same as we saw in early October when Le Cornu resigned and was reappointed a few days later. However, of course, there is the subject of having no budget for France. What does it mean? For example, for the social security budget, it means increasing the social security deficit from 20 billion to 30 billion euros. It means possibly some special laws in order to roll over the 2025 budget into 2026. So this process is going to take a long time. The risk level clearly could still increase. The deadline for the vote on the overall state budget is December 23. And with all these back and forth between the two chambers, we're clearly dangerously approaching this deadline. Last year, I remember what happened. We had the Barnier government collapsing because he had put his vote of his responsibility on the line. This time, it's not going to be the case. But we may have no budget in France until March or April next year, according to the budget minister. That means no reforms, deficit that keeps increasing, debt levels of France that may, in the longer term, become unsustainable.
Okay. That feels like a familiar theme. We'll see exactly how it's going to play out this time. Caroline, thank you very much indeed, Caroline Conan, on what is happening with the French budget debate. Let's talk about what we're going to be seeing from the rest of today. 2 p.m. we got the vote in France. Later in the session, the Energy Information Administration is due to release its short-term energy outlook. Oil prices have been coming under a little bit of pressure. Gas exports are a big theme in the United States. There's a lot of exports, which is potentially driving up gas prices over in the United States. Jolts data from the United States a little bit later on, always backward-looking, worth paying attention to. I think it's a tiny bit more backward-looking than normal. Anglo shareholder vote, Tech Resources shareholder vote coming up a little bit later on. But it's Fed Day 1. I think that's kind of the main thing.
Yes, it is. And the thing about Fed Day 1 is it never delivers anything because you have to wait for Fed Day 2.
Actually, to be fair, we have to wait for Fed Day 3. Because basically,
we do in Europe, yes.
It's basically a 3-day process.
It is a 3-day process, so get ready. Right, let's bring in Bloomberg's Valerie Teitel. She's with us for this 3-day process that is the Fed. Val, yields have been on the rise. We talked about this a little while ago. Europe yesterday, Japan last week. US Treasuries have been catching a little bit of that. The RBA overnight. What does this tell us?
Yeah, no, it's been an interesting thing that Treasuries are being dragged around by global factors instead of normally what we see is the other way around. Treasuries leading the rest of global fixed income markets. But it has been a confluence of factors that have seen U.S. 10-year Treasury yields rise around 25 basis points, just in the month of December alone. So the market is getting a bit worried that we could be breaking out of these recent levels that we've been really stuck in for the last 3 months when it comes to Treasuries, and that could be higher. This is all on the back of the market pricing in, a higher terminal rate next year, which is surprising given the last 3 months we haven't really gotten a lot of new data. We're still waiting on this backlog of data. We're still waiting for some clarity for the Fed. I don't think we're going to get that tomorrow, given how contentious and divided this Fed is and how much they're still waiting on the November backlog as well. But interesting to see that it's really also been the belly that's been leading this sell-off. So not necessarily what people are thinking immediately about central bank policy, but what we could get next year, be it a more hawkish Bank of Japan, a more hawkish ECB, as we heard from comments from Isabel Schnabel yesterday. So the belly's really leading this, and we're seeing a repricing globally of the neutral rate, essentially.
I'm not sure I want to think about 2026 yet. There seems to be a fair few things to think about in 2025. Is it safe to put my Christmas tree up yet?
I would say that this year is different because normally after the second week of December, everything quiets down. But now that we have this backlog of data, the November CPI and the November payrolls are going to be released in the third week of December. So honestly, we could get some pretty decent volatility right up until year end. We know this is a very illiquid point for markets. You have, various portfolio managers really not wanting to take a lot of risk, and whenever they see, even just a shred of losses in some positions, they want to cut them and crystallize their gains for a year. So I really think that, headed into Christmas season, that last week of December, we could see some real volatility. I think a huge curveball could be the Supreme Court ruling on tariffs. We're hearing from the street that really this ruling can come any day now.
And Trump's clearly worried about it.
He's promising these stimulus checks in the back of tariff rebates. He's really trying to position himself for what he's going to do if he loses the Supreme Court ruling. But this could have a bad effect on the Treasury market. We saw last time around when there was worries about the Supreme Court ruling that essentially we had a big sell-off in the Treasury market because they have to pay back this tariff revenue. That's something that's been sitting in the U.S. government coffers. So it's negative for the deficit, again, which has really made little progress since Trump's been elected.
If that happens, though, we will go straight into that conversation about how President Trump is going to get this revenue anyway through some other measure. I'm just predicting that will be the conversation, won't it, Val, about whether there are other levers he's going to pull, other tools he can use. Interesting on a stocks perspective, the MLive team had a pulse survey of investors that showed there are expectations that US stocks go quite a bit higher on the back of that kind of Supreme Court ruling. So what might worry the end of the bond market might pop stocks higher.
I think that would depend on whether you think that now that Trump is not allowed to use these emergency powers for tariffs, if we're less likely to see tariff-induced inflation next year. And that's a thing that, is continually being discussed, whether tariff-induced inflation is something that already happened or whether it's something that's yet to hit the market. And that kind of discussion, I think is likely to really rock the market next year. As soon as we decide whether tariff-induced inflation is in the rearview mirror, we've already seen it. There's nothing more coming. We could see a big revision lower in people's CPI forecasts. I know you're raising an eyebrow to that because you doubt that kind of optimism about progress on inflation. But again, obviously we have November CPI to wait for. Then we have the December.
We had one guest today who was not worried at all about inflation.
He did then go and highlight the risk. It was the same. If it was Chris Watling. So my question is, if the Supreme Court throws it out, do we get another moment where you have another sort of board and he stands in front of it?
So more theatre.
Does that happen again?
Well, look, the administration has been very clear that they have plenty of tools to use in order to replace this kind of tariff revenue. It's whether it actually happens, just how long it does take them to replace the IEPA, the Emergency Powers Act that they have been using.
I'm assuming, so I'm going with no, not safe to put Christmas tree up yet.
Yeah, I think that's the conclusion of many of my conversations with Valerie Total towards the end of this year.
It'll go up
Bank of Japan, we could also get a surprise
Bank
there.
of Japan, that's going just before Christmas.
Don't close it up yet.
No, absolutely. Valerie, thank you very much indeed. I'm going to catch up on the conversations around the aviation sector with Willie Walsh out with IATA's big report of the year. We'll have that on the brief a little bit later on, around 10:40. That wraps things up for the opening trade. The Pulse is coming up next. This is Bloomberg.